Good morning and welcome to the Killik & Co market update. This week our Chancellor Rishi Sunak has announced the details of his mini-budget, which comes ahead of the main budget in autumn of this year. One of his main focuses was on preventing high levels of unemployment, and he's done this by offering financial incentives to companies to bring employees back from furlough rather than making them redundant. He's also tried to encourage people to go out and spend by offering VAT reductions in the hospitality sector, and he's also tried to stimulate the housing market by offering a stamp duty holiday for properties worth less than £500,000. We didn't see a huge stock market reaction to this budget, but we did see a gradual rise in sterling throughout the day, and that implies that the budget is seen as being good news for the UK economy. The stamp duty holiday did cause a positive share price reaction in the house building sector, particularly for house builders that are based outside of London, where the selling price of houses is more likely to be less than £500,000. Here's the share price chart for Persimmon, which has an average selling price of about £225,000. This is a 5-day share price chart, and you can see there's quite a clear rise in the price around about 12:30 p.m. on Thursday this week, and that's when this mini budget speech was taking place. It is reassuring to see all these measures being put in place to try and support our economy, but we really need to wait until October to see what happens when the furlough scheme ends. Shares in electricity transmission companies National Grid and SSE have been weak this week following a disappointing announcement from the regulator Ofgem. To understand this, let's have a look at the key players in the electricity market. First up, we've got the generators who are operating the nuclear power stations and the wind farms that generate the electricity in the first place. We've then got the transmission companies that own and operate the grid, or the system of cables and pylons that transport that electricity around the country. We've then got the distributors who own and operate the smaller networks that take that power from the grid and deliver it to individual homes. And finally, we've got the suppliers that buy the power from the generators and actually sell it on to the individual homeowners. Yesterday's announcement from Ofgem was bad news for the transmission companies. Transmission companies are essentially operating monopolies. National Grid operates the grid across England and Wales, and SSE operates the grid in Scotland. Because these are monopolies, there is a regulator that sets a maximum level of return that these companies are allowed to make. And yesterday, Ofgem announced that the allowable return for the next 5 years will only be about half as much as the return they've been allowed to make over the last 5 years. So clearly bad news for these companies. But the argument these companies are making is that over the next few years they need to make a lot of investment into the grids to account for the fact that a lot more renewable power is coming on stream, and the grids need to be adapted to account for that. And they're saying that with these low levels of allowable return, they won't be able to make that investment, and therefore these companies will be appealing the decision that has just been made by the regulator. And finally, there's been lots in the news about Boohoo Group this week, following a report by the Sunday Times that claims the company is using suppliers based in Leicester that are paying its employees just £3.50 per hour. Boohoo previously had been one of the beneficiaries of lockdown, as more and more of us were forced to buy clothes online, but this report by the Sunday Times has caused the share price to fall by approximately 1/3. One concern here for investors is Boohoo's profit margin, which to date has been around 7%, and that's a lot higher than some of its competitors, for example ASOS, which has a profit margin of less than 2%. Boohoo has previously said that its margin is high because it makes more of its own clothes, but clearly there's concern now that its margin is only so high because it's using suppliers that underpay their employees to such an extent. So that's one concern for investors, and another is clearly the ethical consideration. Ethical investing has become more and more popular over the last few years, and nobody wants to be invested in a company that's treating its employees this badly. The company has since announced that it has launched its own investigation into the claims, so we'll have to see what happens there. Moving on to next week, corporate reporting season is starting again, so we'll start to get more insight into how companies have performed over the last quarter. Next week is a big one for the US banks. We've got reports out from JP Morgan, Citigroup and Goldman Sachs. That's it from us. Have a great weekend, and we'll see you next Friday.